Welcome. Thank you for joining us today. Today I'm going to be talking about pay as you earn. If you are new to this channel, don't forget to subscribe, follow us. Pay as you earn. In this case, I'm going to be using the Zimbabwe example. Is determined through the following tax table. The rate of tax ranges from 0% to 40%. If you're somebody who is earning below $100 per month, you pay tax at a rate of 0%. If you're earning between $100 and $300 per month, you pay tax at a rate of 20%. And then somebody is earning $300 to $1,000, they pay tax at a rate of 25%. This goes up to somebody who is earning $3,000 and above, they pay tax at a rate of 40% per month. Or this can be annualized or per annum. Everyone falls under this cash flow quadrant. You are either an employee, a self-employed, a business owner, an investor. So as an employee, your income is based on time. The more time you spend at your workplace, or you get work overtime, so you end up earning more money. So your income is based on time. As a self-employed person, again, the more time you spend working, you earn more income. So the difference between an employee and someone who is self-employed is that the self-employed somebody is somebody who is in charge of his job, but an employee reports to their boss or employer. Then as a business owner, your income is not determined by don't have to be physically or at your business. It's not active income. You have employees that determine your income. So your employees, they work for you and generate income for you. Then as an investor, your income is determined by the amount of money that you put in to invest. So the more money that you put into a particular investment, the more return that you are expecting to get from that. So here I want now to do a simple calculation to show you how you determine your pay as you earn from your employment. For this individual, his basic salary is $500 per month. He gets a transport allowance of $100, airtime allowance of $50, and the cost of living adjustment of $300. So his total earnings now add up to $950 per month. So we use here a system of final deduction system for calculating the tax. So from his total earnings, we subtract allowable deductions of NASA, which stands for National Social Security Authority. This is a statutory requirement that everyone in employment must pay 4.5% of their earnings to this fund. Then also a pension, if you have a pension scheme, just use the rate of 5% on basic, which means you also deduct that from the total earnings. So we are deducting the NASA contribution and the pension contribution, which is $42.75 plus the $25, which means if we separate those from $950, we get $882.25. This is the figure that we will not use to calculate our tax pay as you earn. So the rate, this individual falls in the 25% bracket. So 25% of 882, and then we less $35, we get $185.56. Then we say calculate 3% AIDS levy on that $185.56, which comes to $5.57. So this person's net pay comes to $691.12. Our total pay then adds up to $191.13. So this is the basic calculation for someone that is in active employment. Their take home is $691.12. So note here that they haven't taken out, separated their living expenses. So you are taxed before you spend. So the difference between this individual and somebody who is in business, as a business owner, you are taxed at a rate of 25% plus 3% as level. This is after you subtract all your expenses from your revenue. Suppose you remain with your taxable profit, say $1 million. This you are not your tax rate does not increase because your profits are higher. Your profits will still get taxed at 25.75%. Suppose this person as well gets same say a profit of $500. The tax rate does not reduce to say 20% to be the same as the one as someone who's in employment. The tax rate remains at 25.75%. Then also, if you've invested, you've got property that you acquired some time, or you manage to buy property and then you decide you want to sell, the tax rate you pay tax, the capital gains tax at a rate of 20%. That is if you've acquired that property after 1 February 2009. But if you acquired the property before that date, that the capital gain is subject to tax at 5%. But the beauty of having an asset that you invested in a property is that your taxable income is adjusted for inflation. Suppose you acquired your property, say, for $5,000 in 1990, and then you sell it today for, say, 500,000 US dollars. There's an inflation adjustment that is applied, then is subtracted, and you may end up paying tax on, say, $100,000, not on total amount that you received after you sold your property, 500,000. You may end up paying tax on, say, $1,000 after the inflation adjustment. So you see that the advantages of having invested in an asset that you later on sell. Then it might also be somebody who has got shares in a particular company. The company declares dividend. That dividend is taxed at a rate of 10% for local residents, and then for non-residents, taxed at 15%. So note again that you might have earned a dividend of $950. Same with that person whose total earnings is $950. But in this particular case, your dividend is taxed at 10% versus 25% for underemployment income. Again, you might have had some savings in your bank. You earn interest, but that interest is taxed at 15%. So you get to keep what? 85% versus 75% underemployment income. So the advantage is here. So you see the tax systems seem to favor a passive income versus what? Active income. If you are under active income, your tax rate increases the more as you earn more. But under passive income, your tax rate remains the same, no matter your money is increasing, or your revenues are increasing. The tax rate remains the same. So there are advantages. So I encourage you that as you work, set aside some money that you put into investment, so that as your money increases or it grows, you are able to reduce the rate of tax that you pay. Let's hear your comments on this subject of pay as you earn. Want to hear what you say, and then we're able to discuss this further and get you to understand more. Thank you.